So many buyers think that their mortgage payment will stay the same for 30 years, but that's only partly true. And your total monthly mortgage payment is comprised of several different factors. Number one, you have your principal amount, which is the actual loan amount itself that you're going to be paying down. Then you have the interest, so that's the amount that the lenders charge. It's the cost of borrowing money. Then you have your mortgage insurance, which if you are putting down less than 20%, you're gonna have a monthly mortgage insurance that's also fixed. Then you have your property taxes. And your property taxes, it's not being charged by the bank, it's actually being charged by the county, and they're the ones that sets that figure. And you also have your home insurance, which your home insurance is there to protect your home in case you have some kind of natural disaster, fire, anything that can destroy the home. These two, your taxes and your home insurance, are going to be what fluctuates. They're also held in an escrow account. The rest, like your principal, interest, and mortgage insurance, if you have a fixed rate 30-year loan, then these three things are locked. Now let's go over what an escrow account is. So your escrow account is like a savings account that your lender manages. And what they do is they hold in that escrow account the amount of money to pay your property taxes and your homeowner's insurance at the end of the year or whenever it's due. The reason it's set up like that is because a lot of people, it's a very huge bill, it's thousands of dollars, and a lot of times people can't pay that just outright. So that's why they include it into your monthly mortgage payment, so that by the time the end of the year comes or whenever that bill is due, you have enough collected up front to pay that. So you are paying into that escrow account every month through your mortgage payment, and think of it almost like you're saving up for a car. You have a jar, you put money into it every month, and then at the end of the year, the money is there to pay that bill. Now, here where it comes. So there's several reasons why your property taxes can go up. Number one, your property taxes are based on the county's. So there's several reasons why your property taxes can go up. So number one, your property taxes are based on the assessed value of the home. So if the value of your home has gone up, then your property taxes are going to go up. Again, this is based on what the county, how they assess your home value. Number two, if you have new construction, a lot of times before you close on the home, the property taxes are already based on the actual land amount, so it's going to be very low. Once you close, the county reassesses it based with the final home, the final structure, and the value of the entire property, and that's how the property taxes can increase thousands of dollars if you have new construction. Number three, if the previous owners had any discounts like senior citizens discounts or homestead exemptions or exemptions for being a disabled vet, then after you close on the home, those discounts get taken off. That's another way that your property taxes can go up. Now let's go over why your home insurance can go up. So your home insurance policy is only good for 12 months or 1 year. After that 12 months is up, then they renew your policy. And this is when your policy amount can change. And it can be based on a lot of factors. If you've had any claims in your area, even if you yourself haven't filed a claim, if your neighbors have filed a bunch of claims, that home insurance is going to go up. Two, if construction and labor costs are rising, then it's going to be more expensive to rebuild your home. If something happens to your home, that can increase your home insurance premium. And two, if the value of homes are increasing, that can also increase the cost of rebuilding a home, and they will increase your home insurance as well. Now let's go over a few other costs that can drive up your payment. Now here are other hidden costs that you want to make sure you're aware of. If you have an adjustable rate mortgage or an ARM, that rate can increase. It's normally fixed for a certain period of years, and then from there it adjusts based on the market rate. So you want to make sure that you're aware of how many years that it's fixed, because if it does increase, that will definitely impact your mortgage payment. Then look into HOA. Annual fees can rise year after year. Even though this is not directly in your mortgage payment, it's something that you want to make sure you're aware of. That can happen. Two, you can have utility costs, energy cost increase, especially if you have an older home with an older AC. That can impact the energy efficiency of your actual home. Now let's go over what you can do to prevent your mortgage payment from increasing. So if your property taxes has increased, then you can actually appeal those property taxes. And what you want to do is you can challenge it with the county. What you're actually challenging is the assessed value itself, not the actual property taxes, because again, your property taxes are based on the assessed value of the home. So you can appeal this. You'll set up a hearing. Make sure you come with your evidence to supporting that the value that they're assessing is actually truly less than what they're assessing that. And then from there, once the judge rules and looks at all your evidence, they will adjust your property taxes. Now, with your home insurance, you want to make sure that you are shopping this around every year, because again, your policy is renewing renewing every 12 months. And most of the time, if you're not shopping it, you're going to get killed on the rate and the fees. And you also want to plan ahead when it comes to any escrow shortages. So every year, look at your property taxes, reassess that, and also reassess your home insurance to make sure that you do not have an escrow shortage, because it's easier to catch it up front than after it happens. So if you think that renting is going to be the easiest way to get out of this, or it's immune to a payment increase, think again. Because at the end of the day, landlords are facing the same issue with rising property taxes, rising home insurance. The only thing is they're able to pass that increase off to the tenant. And on average, rent increases anywhere from about 5 to 6% every year. And in some years, we've seen as much as 15% increase. So at the end of the day, it's important that you understand how to manage your payments so you don't just end up renting and not building up your equity and you're paying someone else's payment. Now let's go over tips on how to manage your payment. So when you're out shopping for a house, you want to make sure that you are not buying at the top of your pre-approval amount and maxing out your budget. The reason is a mortgage payment increase over time is going to happen. It's just a matter of when. So you want to make sure that you factor this in on the front end to give you a little bit of room so you don't become house poor when it happens. Number two, you always want to make sure that you have an emergency fund set up so that you have at least reserves after you buy the house. You want at least anywhere from 3 to 6 months to cover the mortgage payment if something happens. And number three is you want to make sure that you don't rely on the promise of a future refinance with lower rates that will lower your payment. Make sure that you are comfortable with your mortgage payment as is, because at the end of the day, no one has a crystal ball. Rates could go up tomorrow, rates could go down tomorrow. So just be sure that you are comfortable with your current payment. So owning a home always comes with rising costs, but being prepared always makes a difference. And if you love this video, then you're going to like the one that I just posted on everything that you need to know when it comes to VA home loans.